If you want to know the real technical details about moving averages, this is not the session. This is about more so how we use it and what we look for and what its purpose is. What are the values that we use? What's the response and how we respond to it? Here we've got gold on the daily chart. We mapped our moving averages, and you can map them out easily with indicators. You select your indicator, and there's two types that we can use: EMA, and you can use this one here. And I tend to like the TGMA, sorry, right down there, and that gives you the option of changing colors for uptrend and downtrend. So here we go. That's the details there. We could, for uptrend, we can say black. For downtrend or neutral, we can say blue, and red for downtrend. And we can change a whole bunch of stuff, even with timestamp. So if we put the weekly here, give us a sec. And we like to make the weekly stand out. Now you can see the weekly average there. It has confluence at times, not that often here. And that value is the 21 moving average. Some people prefer to use 20. And realistically, depends on the content, the chart, and you might have to adapt to it. So here you can see it's slightly up too high for us. So 21 for me is my normal one that I use. And the moving averages really depends on the cycle, the market cycle. From the bottom, we look at moving averages, and then the trend, and then we use moving averages at the top for means of finding a reversal. In other words, the trend potentially changes. This is all covered under the trend module or trend exercise. Here we're going to use moving averages for support and resistance. That's what this session is about. I need support and resistance. On the 20 moving average, we can use it on the daily and the weekly, and that's it. That's what we tend to use it for. We also use a 10 daily, weekly moving average. We use a 50 daily moving average on the uptrend, and the downtrend helps us out, and so on. This is all documented in the course, and the details are there. Bit of a summary. This video is but just to emphasize on the way we use it. Now, I have this tool, this script, that's already mapped it out. It's a tool that I use, so it saves me a bit of time. What we want to do is look at an example where we can use it. So this is an uptrend. At the time, gold was going sideways. So if we use our method, we swing high to swing low. Let's close in. So price comes, hits a level that is pretty much resistance, comes back down, finds support, and then price ranges. Now we have our 21 daily moving average, and then we've got the 50. Let's get rid of these two. And this one here. Okay, it's still there. We can get rid of that as well. Actually, let's leave that in. It's the weekly one. What we see is price coming, ranging, and we can't really use the moving averages there. What we do is when we break out the range, then we rely on the moving averages. And you will see here, we look for confluence. Using the Fibonacci, we pull our price down to the last pivot point. We look for the golden ratio, and then we look for potentially other factors like moving averages is really the good one here. The middle of this range, if you do it right, is 50%. And we have a coupled with the moving the Fibonacci. That is a good level because the moving averages are there as well. And then we get this bullish candle, a reversal. We get the back test again, roughly here. liquidity sweep, and then price keeps going up. So price, in this context, we have an uptrend. We have 1, 2, 3, 4, 5, and then up. So that pattern, 8-wave count, is applicable. It fits our scenario to include moving averages over here. Let's just reduce that size. That makes sense that we can use this. Sometimes it could be that, but that's a 10. The 20 is relatively good for us. The strategy really depends on the context, right? But in this context, moving averages supports it. We can use anchored VWAP as well to see if that has confluence, and it does. So we've got moving averages and anchored VWAP acting as support. Perfect. Entered along. Another one up here. In this case, it makes a big, strong move, pulls back. So we had a base there. We had a swing high there. You can see the golden ratio acting as a resistance. This time we take this liquidity out as well. So we take a bunch of liquidity. This bullish candle closes above this bottom. Good sign on the daily, and price continues up. And in this case, it has confluence with this moving average, which is the 21 weekly. So you can see there was a tap there on the 50, and the 20 moving average acts as resistance. You can see how the moving averages work. Again, we'll use our anchored VWAP to see if there's any confluence, and perfect, right there next to the 20 weekly moving average, or the 21 moving average. That is a number of factors that come into it. You can see how my mind works when it comes to moving averages. It is a bonus factor. It's not what we can rely on itself, but it does help us at times to find the short. Here we have no moving averages to help us out, but on the trend, moving averages help. And this one, I dare say the 10 will be, it's going to come into here for sure. Let's see how we go. There you go, the 10 moving average, because it's a strong trend, it's picked up. Here we don't have any support at all. Continuing on, there's a point, here we go. So when the moving averages come close together as well, you understand there's a compression taking place, and then if it works out to the right direction, the compression expands and widens, like here. So the lines come close, and when the price breaks above that compression, it's a blue sign there, because it starts using those moving averages as support, and you can see price go up. Here we can see the 10 takes place at some places. Yeah, look close again. Once price breaks above it, it acts as support, and then continues on access support. So the 10 continues acting support, the 20 does, and the 50 doesn't really come into it anymore. When it breaks to the downside, the crossover indicates more compression or more downside. So you can see how we can use these moving averages. Now here we are. The moving averages, especially the large ones, are crossing over, which tends to be a bearish signal, but we can't use that. What we see is it's crossing over here. So we've got the 10 and 20 moving average crossing over. Then the 50, that is a bearish sign. Right there is a bearish sign, and the rest plays out. So it's likely that when we get those moving averages crossing over again, it's a bullish sign, and that continuation. Here we have anchored VWAP acting as support for gold. We don't have anything else. So let's look at Bitcoin moving averages. It's in a similar fashion, but more specific to that price action. Daily moving average with exponential maths applied to it, and then we're going to add the daily, or the 21 daily SMA. It's another algorithm, math formula. So we have in here EMA, and the other one is SMA, and they tend to help us out on the smaller time frame or the larger time frame of moving averages for the trend. But they're also at times act as support and resistance, and there's a method of trading that. So let's look at an example here, right? The 21 moving average finds price comes down, 21 moving average of the EMA and SMA acts as support as price comes down, and at times it wicks below it, and at times when it regains it becomes bullish. You can see that. You can see the behaviors all the way through. There are times where it's support and resistance. So 21 moving average on the daily is handy. We have the 50 as well. Let's put the 50 there. These are numbers that you should be familiar with. So what we're going to do is just hide the other two. Like the 50 moving average, resistance, and when it's broken, bullish, support, resistance, and then up. There you go, support all the way through, and you can see the 50 moving average. So that is a dynamic support and resistance level. So what we have is we look at our strategy based on where the price is. We use moving averages accordingly. The 200 weekly EMA and SMA is for the larger time frames and the trend. The 50 is also in the between the small time and the large time, so somewhere in the middle. 50 gives us an indication where the trend could be very bearish or bullish. And then we've got the daily levels and even the small time frames like 4 hours and 1 hour. Sometimes they help us out with confluence. Ideally, the 200 moving average, say if we were to look at the 200, you'll see that we put the 200 daily, SMA, EMA, and the weekly. And that was it. There we go. So let's just go through this. You can see the 200 SMA and EMA, resistance, in context, that is very important, and they're the bear market. So we've broken a below the 200 and back testing it, it failed and it went down. You'll see it here as well. Look at that. More confluence with the Fibonacci, the anchored VWAP, and moving averages. That was a strong resistance level, and that's why it's dropped. Similarly here, when we regain the 200 moving averages, look at that perfect support level, support, and at times resistance. And in context with other price action, it tells you something's happening at the time, and it's important, the 200. Yeah, we don't have any 200s yet. Let's put that 200 weekly, and now you see the 200 weekly acting as support there. Look at that, support becomes critical. When we lose it, it drops a lot. And here we don't really, it's a mess there, so it was a bit confusing for me as well. But if price was to come here and these two coincide, that's going to be a great point of resistance. Let's look at this. Say price was to come up, just so price comes up, that would be a strong resistance. Why? 200 moving average, dailies coming down, that is a strong resistance, and all we need is a Fibonacci, and for Fibonacci, oh, there you go, 0.5. That would be a perfect position to short and come back down. And this, from an Elliott Wave perspective, does look like it. It's an A and a B and a C. Look at that. So this is just an introduction to what moving averages could be, fixed range volume profile, anchored VWAP, and we have our trend lines and so on. I hope you enjoy this. Give some feedback and I'll talk to you soon. Cheers.